Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending May 17th, 2024. I'm Preston Britton. Thanks for tuning in. Well, the theme for this week is interest rates versus earnings, and which one is going to win out on this battle here. Are rates going to come down sometime this year? Or are they going to stay higher for longer? And will earnings hold up if interest rates stay up higher for longer? Well, let's just delve into how the week came out. Let's just take a look at this past week. You can see everybody finished in the green here in the U.S. markets. Really strong market. In fact, all major indexes, besides finishing higher, each of them made new all-time highs. As we did see inflation and interest rate worries, they kind of appeared to dissipate just a little bit, while growth stocks continue to stay strong. And speaking of earnings, earnings growth year over year coming in for Q1 so far is at 5.4%. We have few companies left, but right now we're running at Friday's close 5.4%. That's the largest increase in earnings in almost 2 years, right? But just understand, you can see the PE ratio, the trailing's 23.83, and even though the forward is less by just slightly under 10%, coming in at 21.62, that's still fairly rich, okay? And with the S&P trading at around 21 plus forward earnings, there's still a good argument that Wall Street has already priced in a better than expected earnings for this year, right? So that leaves corporations with very little wiggle room to avoid disappointment. In fact, what we've seen so far in Q1, companies that have missed earnings have seen their share price fall on average about 2.8%. Right? That's higher than a 5-year average of 2.3. However, those companies that have beat expectations or have exceeded have only seen their share prices rise an average of 1%. That's kind of in line with the 5-year average of about 90 basis points. So the bar is getting stronger or higher, better said. And companies that come in at or below expectations are not doing as well. They're underperforming, right? So the other thing is the Feds may be influencing a higher bar for corporate earnings because we're getting falling expectations this year for multiple rate cuts. You keep pushing rate cuts back. I think there's like a 60% chance of a rate cut in September of this year. So what that does is it forces big firms, hedge funds, mutual funds, and others to go into their pricing algorithms and factor in a higher discount rate for future cash flows, which basically that makes stocks look even more expensive relative to fixed income assets like bonds. So that's going to make it a little bit more difficult. You can see the earnings yield right now for the S&P is coming in at 4.58%. The 10-year Treasury is 4.42. It's higher than the dividend yield of 307 basis points, right? And you can see the S&P yield over the 10-year Treasury is only 16 bips. So you could essentially get according to, risk-free, nothing's risk-free, but as close to risk-free as you can get for the earnings yield of the S&P. So that continues to divert probably more money than normal into the U.S. Treasury market. Okay. So we're seeing that the current VIX came in sub 12. We haven't seen that in quite some time for the week. Last week it was closed out the week at 12.5. That was our 12.55 already, almost a couple of year low, and now we're below 12 at 11.99. Okay, so we've had multiple weeks of the VIX coming in lower and lower. So you got to be careful when the VIX starts to get, below 14, and now we're below 12 to close out this week. And you could see the best performer for the week was technology. The worst was industrials. But look at the year-to-date sector performance. Very rarely will you see a strong market where the S&P year-to-date is up over 11%, and yet utilities are up 15.17%. That is an unusual phenomenon, and that is the market's pricing in the opportunity of rate cuts coming down, not going up. In fact, this past week, what helped support sentiment was the CPI data. I mean, it came in at or modestly below expectations. The CPI rose to 3.4% from a year ago. Expectation was a little bit higher. Core prices came in at 3.6%. Now, you may think that these are still pretty high. Isn't inflation still well above the Fed's 2% target rate? And the answer is yes, but the important takeaway that the market seemed to be taking from these CPI data points is that inflation is not reaccelerating, which is really important according to the Feds. In fact, it's only going lower, and they do not see, or the markets do not see, a rate hike in the future. So the markets are making the assumption that let's make bets on those equity and other assets that do well in interest rate environment that's going to go lower from here. Okay. The the CPI print was 4.9% year over year last April, and so we're seeing this coming down now. Also understand that retail sales were flat in April, versus the consensus estimates of a 40 basis point gain. And that was downwardly revised from their March estimates. So they lowered that as well. So data included some evidence that consumers are starting to pull back on some of their discretionary spending. And that kind of drove a little bit the 10-year Treasury yield to its lowest level in over a month. So, but net, the markets are making the assumption that there will be at least one rate cut, but the next rate adjustment is going to be to the downside, not to the upside. Inflation seems to be coming down, and earnings growth coming in at 5.4% for Q1, the best in 2 years, is almost like a Goldilocks scenario. So will there be a soft landing? And you're going to see this debated through our next meeting in June. Now, keep in mind the next Fed meeting is about 4 weeks away after the long holiday weekend here in the U.S., Memorial Day, not this coming weekend, but the next weekend. And then in a few weeks in June, we're going to get the next Fed meeting, which is going to be very important because that's a quarterly Fed meeting where we're going to get the dot plot. And then I'm sure that's going to help set the path for the markets for the next quarter. Okay. So that's a little bit about what I'm seeing here in the U.S. markets. And of course, we go over across the pond to Europe. See, everybody in Europe is more of a consolidation. Year to date, they're all very strong, right? Almost 12% for the Euro stocks. That's 50 of the largest companies in Europe. FTSE's up triple eights, 8.88%. CAC 40 up over 8%. DAX over 11%. So this weekly number just, pretty much steady. The slight pullback is just a resting period for Europe. And the ECB policymakers indicated that a rate cut's likely in June, although thereafter the path is uncertain. And we did see Eurozone industrial production rise for a second month in a row, 60 basis points year over year. So those all show positive signs for Europe. And you may get the idea that Europe could outperform the U.S. in the second half of this year, right? And this may be the first time that we get a rate hike over in Europe without the U.S. leading the way. I mean, a rate cut in Europe without the U.S. leading the way. And then, of course, if we go over the Asian markets, you see Japan. Investors over there, the Nikkei, they kind of shrugged off weakness in their economy. They had a weaker than expected Q1 GDP print. From the previous 3-month period coming in a little over 2%. The yen also finished the week broadly unchanged in the 155 range to the US dollar. But the 10-year yield slowly creeps up in Japan. The Japanese government bond, the JGB, rose to 94 basis points, slightly under 1% at the end of the previous week. So that's showing a little bit of strength. China was flat for the week. They're doing everything they can to reignite that economy in China. They even lowered the minimum down payment ratio for banks, allowing first-time buyers to buy a mortgage and second home purchases also. They're trying to reaccelerate demand. But home sales prices continue to drop, continue to put downward pressure on the overall equity markets in Japan. And it shows really no sign of a turnaround in this year's long housing crisis. Inflation data also in Japan is continuing to show more deflationary pressure. So that just means the PBOC is going to continue to stimulate their economy. And by the way, Japan is still stimulating their economy, but the big bet is when they're going to take some of that stimulus away and allow the interest rates to rise just a little bit. So that's what we got going on over in the Asian markets. So net, the markets appear to be fairly strong halfway through the year. Okay. If I shift the screen over, I'm going to show you the SPX, the cash index for the S&P, right? And you're going to see on the SPX three numbers that I got on the screen. And let me just, it's going to take a couple of seconds to come up on the screen here, but let me just get that up here and just move this thing around here a little bit. So now you can see on the screen, I've got a couple of pullback points. My first pullback point up here, we hit. The second pullback point, we hit almost right to the T. Notice that I had anticipated a pullback of anywhere from 4 to 8%, which would take us all the way down possibly to a key fib node down here, which also happened to coincide with the all-time highs made in January 2022, should we have pulled back from the previous high point. But we came in actually at 5.91% pullback from the intraday highs that were made back over here in end of March, okay? So now the question is, and this was my revised target to the upside, sitting right around 53.50. All right, and you can see that we're coming right up to my target, which is also an Elliott Wave 5, which, as I told our members, we can expect a little bit of a pullback or a softening of price as we go through the end of May into early June. And then I think after that soft pullback, we're going to make another run and take these numbers out, okay? And then that'll set us up for a possible bigger pullback the end of the summer going into the early fall time, much similar to what we had in 23, okay? And then we came out of 2023 in October, November, and then we've been on that continuous run since then. What I'm going to do is I'm going to shift the screen over and show you now the futures market, the same thing, the E-mini S&P 500 futures market. And the prices are slightly different. Let me just get this adjusted on the screen here like that. And let me just adjust the screen here. It'll take a couple of seconds to come up on the screen here. But you can see the price action right here. And what I'm showing here is with the futures, the futures market. Hang on just one second, guys. My phone is it's not cooperating here. Let's see here. All right. So everybody's trying to reach me on a Saturday morning. But you can see here, I've got a target up here the same, a little bit higher than the SPX, right at 5,400, okay? Off of these lows, we're moving up. Again, same as the SPX, an Elliott Wave 5. And you can see here that I believe we're going to hit it right around a little over 5,400, but then we're going to have a little bit of a softening of price. My target was originally right around 5,000. I don't think we're going to pull back that much because we've got a very strong bullish market coming up here. Now, if I were to show you the volume on this chart, let me just get the volume here. One thing that's a little bit we got to be very careful for in volume. I always like to look at volume when we're getting move ups like this. And you could see here that on this move lower right here, you can see the volume. That purple line right here is a 5-day moving average of the monthly volume. And you could see it move, and the blue line is the monthly volume. So we're up here like that. So we're clearly moving up as prices are moving down. And then the minute we got that bounce in middle of April and moved up like that, look at volume. It's come back down again. So that tells me that we're running out of juice to the upside. And again, my target, slightly higher than where we are now, around 54.25 roughly. We're going to come into this ABC pattern after this Elliott Wave 5, and we're going to consolidate for a bit before we start making another run and taking these highs out. So at a macro level, or at least over the next 60 days, I do believe we're going to see some softening in the price. We're going to see this run up run into just a little bit of consolidation, and then we're going to start to go higher. So we got to see that play itself out. If we look at the, let's come over here and look at the Russell. You can see the Russell is solidly in, well, not solidly, but it is, at least for the Russell, in the green for this year. And it's up, not that much, it's up a little over 3% year to date. But I think the Russell is going to run into a little bit of trouble as well. And then, of course, if we look at the NASDAQ 100 futures, okay, you can see it made new highs this week, up 10.33 intraday on the 16th of May, and a little bit of a pullback, like the SPX and the S&P, a little bit higher. The momentum can carry us a little bit, but I do believe we're going to get some softening of price as we go through the end of this month. And then, of course, if we look at the Dow, all of these making new highs, all-time highs. The Dow over 40,000 for the first time. You can see the Dow came in. This is the Dow futures. It was up 40,358. Now it hit that back on April the 1st, and we're coming back up again. Again, my target for the Dow, as for the S&P and NASDAQ 100 futures, for a little bit higher before we start to come back just a little bit. We may not get up there, but that's what I'm seeing right now in the charts. Okay. And of course, if we look at the equal weight over the SPX ratio chart, you can see the equal weight is hovering around the lows. So the participation in this move higher is done mostly by the mega cap and growth. If we look at the FANG index, okay, and just kind of see where they are, the FANG index, the last all-time high for the FANG index was back on April the 11th. And we're not quite up there again. So, but all growth stocks seem to be doing fairly well, right? Now, if we come down here and we look at the VIX, let me just find the VIX on here. Here we go. 11.99, as I said, we're well in the green. We haven't been down here in a long time. Okay, if I take it back, you can see we haven't been down here. The last time we touched it for one day only was back in December of last year. But since then, we're coming all the way back, all the way back, all the way back, just going back, right? We haven't been down this low since 2020, right before COVID. And then, as you can see, the VIX shot up with COVID into black swan territory. So when we get down this low in the VIX, you've got to be very, very careful, all right? Because the odds favor move it up. Last time we were down around this area, we started a slow, steady slog up until we had not quite capitulation, but we had April just reset the markets, and now we're right back down here again. Okay, so again, when VIX gets this low, the odds of the bigger move in the VIX is always to the upside, which means we're due for a little bit of a momentum shift, consolidation, maybe a slight pullback. So that's kind of what I'm seeing here. And if we look at the bond market, the bonds closed down on Friday. And if we blow it up just a little bit, you can see the bonds are, they've been going down pretty much all year long, right? Making lower highs, lower lows, which means interest rates have been moving up. But I do believe this is going to stop, and interest rates are going to settle in here. We're going to get more information out of the rates here in June when the Feds meet. But I do believe that they're not going to cut rates at least until maybe September, maybe one rate cut before the end of the year. It all depends on where inflation starts to come in over the summer months. Okay. And of course, if we come down here and look at the US dollar, right here, dollar is coming off the highs for the year that were made on May 1st, first part of this month. And then they just been, coming down steadily here. And if we look at the euro, you're going to see the euro has regained right here, the 50 and the 200. I do believe that it'll probably come back, settle in, but you want to buy the dip on the euro, right? So on the euro dollar, any dip you want to be a buyer of. Then, of course, if we look at the yen, you guys know my position status on the yen. I like the yen to the upside, but it's a long-term play, right? So you got to be in it for the long term, meaning at least for the next 12 months. I do believe the yen's going to continue to move up. The Japanese are not going to let the yen stay this weak to the US dollar for a long period of time. Now, they've done it a lot longer than most folks have thought, but I think a changing dynamics there in Japan are going to force them to do this. And if not, the bond market is going to take care of it for them because, as I mentioned earlier, the yen or the 10-year Japanese government bond rose to 94 basis points from 91 basis points last week. So it's going to force the yen up, all right, no matter what the Bank of Japan does. And then, of course, if we come down here and look at precious metals and we look at gold, very strong day on Friday. It's up over 34 points. My target for gold has always been up in this area right here around 2,500. I think we're going to take that out. You can see there's no divergence here. Once we get up in this area, it's going to pull back, but you want to be a buyer of dips in gold. Same thing with silver, right? Silver, you're going to see a pattern here where silver, in fact, made new highs. I got to adjust my chart here, but it made new highs on Friday. Really strong move. It took my target for silver was 30.80, and it moved up and it closed the week right at 31.77. So almost $1 higher. And I doubt we're going to get a divergence in the MACD here too. It may. You don't want to be chasing it on early part of this next week. Let it pull back, but I think it's going to still run higher. And copper, there's a short squeeze in copper. So copper's, look at this, copper is just through the roof, right? So understand there's more forces at play in copper than just a strong global economy. Right now, the markets, both in Europe and the US, feel that we're going to have a soft landing. The central banks around the planet are done hiking rates. So if anything, they're going to be cutting rates. Inflation seems to be coming down. So short of any geopolitical event like a war or something unexpected, the markets globally look poised to move higher. So that's good for steel, aluminum, other metals, as well as copper. But copper is being helped by a short squeeze because everybody thought that copper would roll over, and then here we go, right? So be careful of these kind of plays. And then, of course, if we look at energy, energy's staying right around these levels right here. I don't think it's going to go much lower. I think if anything, energy is going to, like right up in here, I said energy shouldn't go much higher. But if it comes down, I was expecting to stay in the low 70s. It actually came down to intraday low. It was down around the mid 70s. But I think it's going to stay poised around here. Again, geopolitically, there's not a lot of fear premium, believe it or not, in the oil, even though we got Russia going into Ukraine and we got Iran on the sidelines right now, covertly, and Israel and Hamas still duking it out over there. But surprisingly, there's a lot of oil premium that's been taken out of the global energy markets. But I do believe energy stocks are still a good place to be right now. Okay. I mean, I see that. And nat gas, well, you guys know I've liked nat gas to the long side down here, and here it goes. We're already back in the green. That was a low hanging fruit trade. I know I've got members that loved getting long nat gas down here, and I was suggesting it myself. Even in these free updates, it's just a freebie. Play nat gas to the upside. Now, you don't want to chase it. It'll probably pull back a little bit, but on dips, you want to be long nat gas. And then, of course, if we look at gasoline, gasoline, just like oil, you probably want to be a buyer of dip of gasoline right now. And this suggests gas is going to go higher also. All right, everybody, that's my update for this weekend. Everybody have a great one. Members, I'll see you Sunday evening for our 7 p.m. weekly market watch. Take care, folks.